The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Very warm welcome to this Monday edition of Squawk. I'm Steve Sedgwick with Karen Cho, and these are your headlines. The Hang Seng hitting a 2.5-year high amid broader Asian gains after a bumper payrolls print raises confidence the US is seeing a soft landing. Crude prices come off their best weekly gain in nearly 2 years as supply disruptions take focus on the first anniversary of the Israel-Hamas war.
FoxConn posts record third quarter revenue as the world's largest contract electronics maker sees a 20% surge in demand for AI servers. We'll bring you an exclusive interview with FoxConn chairman Hang Seng tomorrow. Rio Tinto confirms talks to buy lithium producer Arcadium as the world's second largest miner looks to build up the lucrative long-term revenue stream.
And shares in French game maker Ubisoft are surging more than 30% amid reporting that the Chinese tech giant Tencent, along with the founding Guillemot family, are considering a possible buyout. Very good morning. Did you have a good weekend?
Good morning, I did. I love the fact that we were both right on Friday.
Good. Yes, were we? What were we right about?
Well, we knew non-farm payrolls.
It's nice to know.
We knew that non-farm payrolls would be big. We set the scene. We thought. We were both
that.
saying that it would have some impact. No, big in the sense.
What I said was if there was an outside figure. Yeah,
exactly.
I didn't know that.
But that's what we said. We thought it could wipe out some of the trades we saw early in the week. That effectively there would be some ramification for the markets, and we had it, didn't we? It was a monumental figure.
Well, do you know? It's funny. My angle that we both wanted to say something at the top of the show. We don't. It's not scripted, this bit, but. My headline said here that the confidence the US is seeing a soft landing. I straight away am disagreeing with my own headline. You know, I could have changed it beforehand, but I like to have this conversation with myself and with you lot and with you. And that is, it says here again, the print raises confidence the US is seeing a soft landing. Well, what about no landing?
Yeah, are we confident about anything at this point?
And to be honest, the comment that I've been thinking about most this weekend when I've been thinking about that payroll figure is, has the Federal Reserve shown a lack of competence? And I know that one of our guests later on feels that they were panicky and it was a silly move to go 50 basis points, given the fact that actually the jobs picture remains solid.
Yeah, it's unhelpful. You just cut by 50 basis points. Now you've got some market commentators saying, should we even be having another rate cut, as they see the data as way too bumpy and going in the wrong direction at this stage. So
yeah, look, I know we've got lots of great commentators. We really have, actually. We've got Steve Englander, we've got David Roche, we've got Bob Parker, Guillermo Renzi Ricci. So we've got a lot. It's Giulio, I changed his name. So we've got a lot of very good guests on this one throughout the show as well. But in the meantime, the market, it kind of got the markets out of jail, didn't it? Because it was that Friday move that got them to the flat line for the week, Karen. Absolutely.
We were losing territory over the course of the trading week before this data point. So the change that we saw in session, 8 tenths up, 9 tenths on the S&P and 1.2 pop on the Nasdaq, enough to push these indices positive for the trading week. Very slim levels, of course, to the upside, given the front-loaded losses for the trading week. But big movers, Goldman Sachs to the upside for the Dow, for the likes of the S&P 500. It was Nvidia, so the big chip play. Broadcom, another chip story for the Nasdaq. Big drivers to the upside. But of course, the market's looking for these signals. What are we watching as we count down to the next Fed meeting? Will it be another 50 basis point rate reduction? Will it be 25? Will it be no reduction now at all? So I think a lot of variables at play thanks to that outsized move that we saw in payrolls. And we'd already set the scene that if there was a number, roughly about 120 to 180, that was a comfort range. And we certainly got out of that comfort range to the upside with the figure Friday. To treasuries as a result, big moves too from what we saw prior week on those bonds. We were, don't forget, trading around 3.56 as we closed out the Friday prior. You could see in session we got to about 3.92. Morning session with 3.95. So elevated on what is a safe haven play, the T-year. So we're watching that very closely. The 10-year still drifting. We're 3.97 morning session. To the dollar, as a result of that bumper move in the yields, you can see it's put the dollar back on target, on the front foot, and as a result, casualties for euro dollar trading down below the 110 level, 109.67. Sterling dollar cable flat in morning session. Big moves have really been felt in the dollar yen trade, and we got to the 149 handle. So very much the ascent of the dollar, destroying that Japanese yen story that has been so dominant for recent weeks. Morning session dollar showing just a little bit of slippage, off 0.1%. A dollar losing territory morning session versus the Swissy. To WTI and Brent, well, it was a monster week last week, wasn't it, for the oil price, thanks to the geopolitics. We're up about 9% We've given back some territory today as we kick off a brand new trading week. We're down 0.2 on WTI, 74 the handle, 77 roughly on Brent as we slip by 0.33%. Gold, the safe haven trade around bullion, also giving back some territory, down 0.2, but that rise in the dollar no doubt having some impact. I want to show you the Asia markets. This is how we approach. Don't forget, we're still ex-China, Golden Week playing out still. The other major boards picking up where Wall Street left off, 2.25% to the upside, or 2.2 now in Japanese stocks. Hong Kong solid, 1.5%. Similar tone for the Kospi in South Korea and Australia, putting on 7/10, somewhat left behind for those fairly large moves elsewhere on the boards. Now, the opening course, let's take a look at Europe, because don't forget, we were on course for losses last week. Some of these markets managing to minimize some of the losses, but we're still down thanks to the trade they saw front-loaded, but also for the session Friday, FTSE didn't do much, and for the week it was down 0.5%. The DAX up 0.5% for the session, but still down 1.8% for the trading week. The French market was one that made gains Friday session, but still again loss-making for the week. We're chasing some gains. Perhaps again, this is somewhat of a catch-up trade, Steve.
Super, right. The non-farm payrolls, as we mentioned, they smashed through expectations on Friday as the world's largest economy added 254,000 new jobs in September. That's more than 100,000 up on the Reuters forecast. And again, my copy here says raising hopes of a soft landing. I would beg you to ask, will there be a landing at this rate? Have they created other problems? Traders now see zero chance the Fed will opt for another half-point cut at its next meeting, with markets pricing in a roughly 1 in 50 chance it could even hold rates where they are next month. University of Penn adjunct professor of finance and former Cleveland Fed President Loretta Mester advocated for a gradual approach to loosening the policy when she spoke to CNBC.
It makes sense for the Fed to keep looking at the data it gets up until that next meeting and then move rates down as it said it was going to do at the last meeting. It's starting a new phase to bring them towards neutral. We don't know exactly where neutral is. We don't know when the stopping point will be. But with the moderation going on in the economy that we've seen so far, which is expected to continue, and where inflation is expected to go down, it makes sense to be bringing rates down at a moderate pace.
Steve Englander is one of the great and the good of the Forex world, and we've been privileged to speak to him for many years. He's global G10 FX research and North American macro strategy at Standard Chartered Bank. Steve, good to see you today, sir. Thank you very much indeed for joining us. Was the Fed a little hasty? Is there a danger that they could reignite inflation, they along with geopolitical events?
Well, I think it would be fair to say that based on the data till now, it's Bowman, the center one, Powell, and the rest of the FOMC zero. And if anything, if you take a look at where bond yields are, they're way above where they were before the discussion of 50 entered the market. So if anything, 50 may even have backfired in terms of achieving the objective of loosening financial conditions. So, I think they have a lot to think about what they do next.
But Steve, the chances of zero cut next time, they look pretty slim at the moment, but the market's got it wrong many, many times as well. One more blockbuster figure like this, and if inflation data, we've got lots of lovely data coming this week as well, and if the inflation data remains robust, are those percentages going to pick up dramatically for unchanged at the next meeting?
Look, it's not our expectation right now. We think that we still think they'll do 75 in the course of Q4. But if the unemployment rate drops again and we get another 200,000 payrolls, I mean, the case for moving diminishes. Powell mentioned it's always been a bit of a risk scenario. If you take a look at productivity growth in the U.S., it's been very robust the last couple of years. Output growth has been, punching above the odds. The possibility that we're in, 1995 to 1999 in, more than the inflation and more than the rates aspect, but in terms of there being a real Goldilocks scenario, a very strong productivity growth and rates can stay high because real return to capital is high. That's always been in the background, but if it moves into the foreground, we're in a very different situation.
Steve, the problem for me is that the data that we saw Friday was, again, very wildcard data. And it felt as though we'd stepped away from that type of shock for the markets, enough so that the Fed had confidence to embark upon a 50 basis point rate reduction. I thought the signals were firming up and they were getting very clear run from here. Now that we are dealing with very bumpy data, what does it say for any confidence in what we're seeing?
Well, I think it tells you that you shouldn't take make big policy moves when the data are ambiguous. I think in terms of the economy, look, honestly, these are payrolls. We know they go all over the place and they get revised all over the place, and it could be minus 200,000 by the time they're done with revising it. But you have to pay attention to the fact that there was a sequence of data last week, all of which was stronger than expected. If it's maintained for another month or two, the picture will change. Right now, we'd still bet that it's a gradual slowdown. And, what the market really is holding on to is that 3.5% Fed funds rate by the middle of next year. If that begins to look like 4, it could be a different equation. But right now, I think the market can deal with these bumps as long as, they're not kind of continuing in one direction and completely reversing the expectation.
Steve, I think everybody's trying to take this report with a grain of salt, but the reality is we sort of move from one side of the boat to the other now. But if you look at underlying the report, there seemed to be some concern in the household segment about what the labour market looked like. So even though the figures were strong from the outset, the households themselves are saying, look, we are seeing weakening in the labour market. Those expectations have always mattered to economists because they tell you about intentions for consumers down the track. What sort of weakening do we have to still be wary of when it comes to consumption?
Well, look, a lot of the jobs that were created were in low-paying jobs. A lot of the jobs that were created were in the government sector, which aren't necessarily low-paying, but they don't, sort of reflect underlying demand. They're kind of exogenous. A lot of part-time jobs being created there. There's a lot to look at to say, headline, can't ignore it, but under the hood, you really want to take a look at whether the engine is pumping away the way the headline suggests.
Steve, final question. I guess our viewers really want to know what they should be doing. I mean, pick your asset class, pick your top trade on the back of what we're seeing in the States at the moment.
Look, I think for the moment that, the market got sort of caught, short dollars and long bonds and is paying the price. I think the adjustment has been really significant. If we, say CPI comes in as expected and, we get something in the range next month, I think this will prove to be an overcorrection in terms of the market, reflecting the positioning more than anything fundamental. So I think, you have to be cautious going into the CPI because a 0.3 on core, would just add to the kind of panic we saw on Friday. But if everything sort of reverts back to normal, I think we'll see the dollar continue to drift down. I think bond yields will drift down from these levels. And I think that the long-term story that people were expecting of a gradual slowing, I think that will be maintained. And Friday's move will prove to be an aberration.
Always a pleasure. We always learn something, Steve. Nice to see you again, sir. Thank you for your time. Steve Englander, Global G10 FX Research and North American Macro Strategy at Standard Chartered Bank. And you can find plenty more analysis on whether the Fed will be able to achieve the elusive Goldilocks scenario. Have they already achieved it? There you go, there's the question. On the CNBC website. Karen, what's coming up on the show?
Plenty ahead today. JP Morgan kicks off earnings season when it reports Friday. We'll discuss what to look out for as Wall Street faces up to a lower rate environment, potentially. Plus, oil prices coming off their biggest weekly gains in over 2 years. We'll get the latest out of the Middle East on the first anniversary of the Hamas terror attack on Israel. And as new Prime Minister Shigeru Ishiba takes the reins, Japan investors grapple with deflation and a BOJ under pressure not to raise rates. Megan McDonald, the CEO of Daiwa Capital Markets Europe, joining us this morning. We promised you a look ahead to earnings season. Here is what could be pivotal for that US earnings season ahead of the first major reports this week. Now, companies in the S&P 500 are expected to report earnings growth of 4.2% on the year and revenue growth of 4.7%. That would mark the fifth straight quarter of earnings growth, but is sharply lower than the nearly 8% expected at the start of the period, according to FactSet data. Now, the largest fall in earnings expectations has been in the energy sector. Analysts expected the sector to see less than 1% earnings decline at the start of the quarter, but now project a fall of more than 20% amid lower oil prices, so real acceleration to the downside. The IT sector is seeing leading earnings growth across the S&P 500. Nvidia is expected to be the largest contributor. If it was excluded, that growth forecast figure would fall to just under 8%. It's a similar story in communication services, where Meta and Alphabet are expected to lead gains. Without those two companies, the sector growth forecast would be just over 4%. Well, forward guidance will be key as companies report, with analysts seeing a sharp pickup in earnings growth in the quarters ahead, including nearly 15% growth in the fourth quarter of this year.
Gosh, so many stats in there. I was struggling to keep up. That's fantastic. Top Wall Street lenders will, as ever, be amongst the first large companies to report as the US earnings season kicks off. We're going to hear from JP Morgan, Wells Fargo on Friday, Citi, Goldman's and Bank of America and Morgan Stanley all following suit early next week. Well, I mean, if we can put some of those Karen boards up again, I thought they were fantastic. And there's a lot to say there. Firstly, just on the energy sector, the rally we've seen, the extraordinary rally last week, is not going to help them out on this one because, of course, that was post the end of the third quarter earnings. So there might be a better outlook for them because as we know of all these numbers, there are, I'll make it very simple. There are three things to look out for. Obviously, there's many more. One, the expected figure. Two, the whisper. And the whisper is as important as the expected figure because there's what everyone says, oh, we're looking for this 6% increase, but really what they want is 8, 9. It's like a Tesla. If you just meet, they get disappointed. And three, the outlook. And I think the outlook from the energy players might be slightly better because of the rally we've seen. The other thing I think that's really important is where does that leave us in terms of the market valuing these stocks and the broader market going into this as well? And there's some very interesting stats out there. I got some stuff from Goldman's. Britt, our producer, found some very interesting FactSet stuff as well. So let's just talk about the valuation of the S&P going into this as well. So according to FactSet, the forward 12-month PE for the S&P 500 is 21.4. I can see it at 22 other places, but you're roughly 21, 22. This PE ratio is above the 5-year average of 19.5 and above the 10-year average of 18. So going into this, we are slightly rich, according to FactSet. Having said that, the Goldman copy, which I forwarded to the team earlier on this morning, is which they updated over the weekend. Today's multiple of 22 times, so we're roughly there, 21, 22. I'm not going to split the hairs on this one. Is in line with our macro model of fair value. Now, I think that's interesting. Goldman's is saying it's a macro model of fair value. FactSet is saying we're actually trading higher than the 5 and the 10-year fair value figure. But what I think is really interesting is we forecast the PE will be unchanged at the year end of 2024 and lift our index target. Now, this is interesting. And if we can put up the S&P as well, the actual level of the market, to 6,000 from 5,600. And I think that's really interesting that actually from the current 57.51 we're trading, they still see a big rally up to 6,000. But the 12-month target, thanks team, will take us up to 6,300 rather than 6,000. So all of that about what you were saying as earnings, I think is fascinating. Whether we're fair value or not, the likes of Goldman's think the market goes higher.
I'm going to talk about three stocks because I think there's only really three stocks that matter at this stage unless you get huge market breadth. Nvidia, number one, seen as the big contributor for IT earnings. The stock has been grinding higher again. So it came off its highs, it tried to recapture them, came off, and it's gone back in that direction again thanks to the September front-loaded gains that we saw recently. So it has been in rally mode certainly over the course of this year. I think there are concerns now about whether the AI spending can be justified, whether the same hyperscaler is going to be spending at the same tune that they have been and what that means for the earnings profile from here. So I think Nvidia's ability to meet when it's priced to perfection now in terms of stock market performance, that's going to be key because it is setting the scene. The other big ones, there was a lot of griping in some of the press coverage over the weekend about the fortunes for Google and Microsoft. Now on Google, and this was thanks to the Wall Street Journal, saying its grip on search is loosening. I mean, that is a big headline. This is something we've taken for granted for many years, that Google is the all-dominant player, 90+% market share in search and pretty much impenetrable no matter even what regulators do. But it seems as though that is not the case anymore. The likes of TikTok is climbing through the ranks, Perplexity, an AI search engine, and of course you've had some of the other models that have been taking place through Amazon, which is taking some of the search. So questioning the durability of Google. And don't forget, this is a hyperscaler as well. Microsoft is the other one. The gains this year of Microsoft actually mimic the Dow. And that is not what we saw prior to this year, where Microsoft was sort of the outlier. And the reality here is that it's spending a huge amount on AI. There are certainly concerns out there that the AI spending is overdone and will not actually bring the returns that some have been desiring.
Let me politely challenge you on these only three stocks that matter, because if that is the case, we could expand it to 3, to 7, to the tech, then that negates this whole thematic from a large number of our viewers that actually there is going to be a rotation going on, there is a cyclical benefit going on, the other stocks and sectors are becoming more important to the growth of the S&P from here as well. So I hear what you're saying. You've picked three of the most dominant players without doubt in the United States. But if that is the case and it's only those three that really matter, then that's almost pushing to the side another 490 stocks, which actually we're relying on rotation and their earnings to fuel that rotation.
Yeah, my point is that if you're just trading the index and you do get any weakening up in those three names, then it's problematic. So you really have to drill down and buy a sector position in sectors or look at something like the Russell 2K, because the old playbook, if it's three stocks that are all dominant, it's not going to help you.
Super. The former president, Mr. Trump, his economic plans are expected to raise the federal government debt by twice as much as the plans of the vice president, Kamala Harris. Now, this is according to non-partisan data. I have to really kind of emphasize that. The non-partisan committee for a responsible federal budget. Now, Trump's proposals include tax cuts for individuals and businesses are seen adding $7.5 trillion to the federal debt by 2035. Harris's plans for expanded tax credits for small businesses, childcare support and higher corporate taxes are expected to net add $3.5 trillion in debt over the same period. The former president held a campaign rally on the side of July's attempt on his life, saying, quote, "We all took a bullet for America," as he gave a 90-minute speech praising the city of Butler and attacking political rivals. And he was joined on stage by the ex-owner and Tesla CEO, Elon Musk, who described himself as dark MAGA. I have no idea what that means, and praised the former president.
The true test of someone's character is how they behave under fire. And we had one president who couldn't climb a flight of stairs, and another who was fist pumping after getting shot. Fight, fight, fight! Blood coming down the face. Now, America is the home of the brave.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.